Holy crap, ladies and gentlemen, if you are an investor in the markets and you're watching this video, meaning you're actively in markets, what you seen today was, wow, nobody could have expected. Off the charts craziness. The NASDAQ at one point today gapping up in pre-market. You were up over 1%. Now, take a look at the chart. You're down about 1.3%. This is by definition what looks like a flash crash. Could there be more selling to come? Well, we'll dive into that here in this video. What is the reasoning for the market selling off today? Two very obvious reasons for this. We'll go over them. And you do have big economic data coming out tomorrow morning that could shake investor confidence even further or give you a bounce back. We'll go over all of this. Wow, what a freaking day for the markets. We will also look at the technicals because the technicals do not look great for the NASDAQ and for the S&P. Ladies and gentlemen, for all of this hard work and effort, the only thing I ask you to do is hit that like button and or subscribe to the channel. Feel free to comment down below. Let me know what you think about this information down there. So there are really two main themes of the day today. This sell-off really started at about 2 p.m. Two different reasons. Number one is the Fed comments today, and that's an obvious one. Number two is geopolitical tensions. But I will tell you right now, this sell-off you're seeing today, yes, it is very dramatic, and going from 1% positive to down 1.5% on the NASDAQ, that's a huge day, but you're also seeing other hedging assets like bonds and like gold that are actually rising today, which in context to the news that I'm about to share with you, specifically the talk from Fed officials that spooked the markets, you really shouldn't be seeing this happen. That means big money is panicking a little bit today. So first up, let's start with some of the comments from Fed officials today. It was really Fed Kashkari that did a lot of the initial damage to our markets. Fed Kashkari said it's possible the Fed won't cut this year if inflation stalls. Fed Kashkari said it's a question of why cut rates if the economy remains strong. Fed Mester, so a different Fed official, says my long-term neutral estimate was raised to 3% from 2.5% in last month's summary of economic projections. That means just the neutral rate from Fed Mester went up 0.5%. That's a big deal. And then you had Fed Goolsbee that came out and said similar hawkish statements as well. He says, in March, I jotted down 2 rate cuts this year, but if inflation continues to move sideways, makes me wonder if we should cut rates at all this year. That's a problem because we started off this year expecting 7 rate cuts. We're now only expecting 3 rate cuts. You've seen certain areas of the markets definitely react to that. Small, mid-cap stocks, they've definitely repriced to less cuts in 2024. You can see the percent of stocks as well above their 50-day moving average has been declining ever since December 28th in accordance with this repricing of expectations for Fed policy, going from 86% of stocks above their 50-day moving average on December 28th, now only to 53.25% of stocks above their 50-day moving averages. But I think the bottom line is when all of these Fed officials, 3 of them today, are basically expressing doubts that maybe we're not going to get any cuts at all this year, that gets you one step closer to raising rates, which would be kind of like a black swan event at this point. So for an equity market that has continued to rise, even though you're expecting more of a hawkish Fed this year, you've really been in a position now for the last couple of weeks where the markets are vulnerable. We're fully valued. You're not getting a deal out there on the S&P or the NASDAQ headline indexes, but there hasn't really been a big reason to sell off stocks either, and it seems like today we got that reason. So those were some of the biggest comments from Fed officials that caused stocks to fall today. That higher neutral rate, not good. Fed Goolsbee, Fed Kashkari saying maybe we're not going to cut rates at all this year. That's a problem because we're still pricing in 3 rate cuts, and the fact that the Fed was going to cut in 2024 and still expected to cut in 2024, that has been a big reason why stocks have been so bullish. But honestly, I'm not as concerned about that compared to this next bit of bad news that we got today. It actually has to do with geopolitical tensions. As you guys may or may not know, recently Israel launched an airstrike on the Iranian embassy in Syria, killing some high-level military officials. This is actually the highest death of a military official via an outside military since the US ordered that strike on Soleimani. He was the guy that was creating the nuclear program in Iran that Trump ordered that back in 2020. And yeah, Israel just killed like the second highest ranking official since that event happened. This article says Israel beefs up air defenses, calls up troops as Iran payback for Syria strike looms. Speculations suggest Iran could attack Israel from its own territory rather than through proxies, sparking wider hostility. So basically, Iran is probably going to bomb Israel soon. And that would most certainly lead to a much larger, wider conflict in that area. And here is the article itself that says Iran vows retaliation on Israel after commander's death, raising fears of a war that could spiral. And this is the guy that was killed in that embassy. So I guess that's a bit of a waiting game to see what happens, what Iran does, how Israel responds, whether or not we get involved. To make matters worse with the geopolitical conflict right now, young Biden said today that Israel basically needs to change their approach to the Rafah invasion, following that report that about 7 different individuals were killed that work for the United Food Bank. And young Biden did say that the U.S. could change their stance on Israel, which is also not great. I am actually a little bit more concerned about this, about the geopolitical tensions, is what's going on in the marketplace today. You can see LMT, Lockheed Martin, military contractor, defense contractor. As soon as the markets really started to crash, money started to flow into Lockheed Martin. That's usually not a good sign. If the markets are crashing and defense providers are rallying, that's a little concerning. But even more concerning than that is what's happening with big money today. So think about what the Fed said. Think about what Kashkari, Fed Master, and Fed Goolsbee said today. Basically, we're not going to be cutting rates nearly as much as the markets expect. Okay, so you would expect TLT to fall on those comments. You would expect rates to go higher on the 10-year Treasury yield, or at least stay stable, but not TLT to go up and rates to fall. Keep in mind, when TLT goes up, when this chart goes up, that means yields are actually falling on your longer term Treasury yields. And we can go ahead and pull that up here. 10-year Treasury yields are down about 5 basis points today. So why is that happening? Why are you getting longer term duration yields falling even though the Fed is sounding aggressive, sounding hawkish? Well, it's because bonds are seen as a safe haven asset. Back during the Rona when nobody knew what was going to happen, even though the Fed was cutting rates, what happened? Well, people bought TLT, right? People bought TLT initially as a safety asset, as really a rush to safety. And then what happened? They sold TLT because they realized, hey, it's not going to be as bad as we think. We don't need all of this protection. And then the rest is history. So when you see a market selling off like we are today, and you're seeing bonds at the same time starting to rise and lead the markets, that's really not a good sign. That's telling you someone with a lot of money is fearful today. And the fact that bonds were actually falling up until this point is definitely not a good sign. Now, gold was also having a similar reaction. Gold was going higher on the markets going lower, and then gold did just start to crater as well in the last hour or so of the trading day today. So I'm not sure what to make out of that, but this kind of volatility in gold is never a good thing. I will point out that gold has been one of the better performing assets in 2024 so far. So a quick little reset on gold. I can't draw any conclusions there, but it's probably long overdue. And with that said, to make volatility even greater, you're going to have the biggest data coming out for this week tomorrow morning. And this is where things get really interesting for tomorrow. Non-farm payrolls are expected to come in at 200,000. If you're much higher than that, then that's really going to solidify to the Fed that they probably shouldn't be cutting rates this year. If you come in at, let's say, 100,000 job ads, 120,000 job ads, that would definitely show a little bit of weakness in the labor market, or maybe just not as strong as, prior months. But if you come in under 100,000 jobs, then the markets are going to be really asking the question, another month or two, we could be losing jobs in the economy. We could actually be seeing a net contraction to people's spending power, which the whole thesis for the markets right now is people in the economy are going to continue to spend money, and that's going to drive earnings growth in the S&P 500. They're only going to spend money if they can find jobs. If we start to get close to losing jobs, that's a problem. And the markets are forward looking, right? So if you come in at like 120,000 tomorrow, people are going to say, what's the next couple of months going to look like? Are people going to be losing jobs? Like I said. So that's why it's important tomorrow. And you will start to see people kind of extrapolate tomorrow's non-farm payroll report as like, what can we expect for the coming months? Same is also true for the unemployment rate, which last month ticked up to 3.9%. In fact, that is the highest the unemployment rate has been in really ever since about January of 2022. So you're hitting a new high in the unemployment rate. Does that non-farm payroll report come in weak? I don't know. Expectations are still 200,000. So if you do come in weak, that's going to be a big shocker. So again, just to kind of clarify this, if you come in too high, that's problematic. If you come in around 200,000, that's good news. If you come in too low, that is also very problematic. And then the unemployment rate, if you go up to 4%, not a huge deal. Doesn't look good, but not a huge deal. If you go up to 4.1, 4.2, 4.3% tomorrow, that's a much bigger problem. If you go back to, 3.8, 3.7%, that could also be problematic as well. So the best possible outcome for tomorrow is status quo. Markets are expecting 3.9% unemployment. If we get that, great. Markets are expecting 200,000 jobs to be added. If we get that, great. You can also see the VIX is up about 15.5% today, and the VIX measures puts and calls on the S&P 500. So you're definitely getting more, hedging activity taking place today. That's not particularly good as well. And if you take a look at the broader NASDAQ, really today was going to be a very important level. We needed to get above this trend line here to get back into this bullish channel. What's actually happened today is you've seen that big sharp reversal. Now you're at that 50-day moving average, which is at $435.36. Right now on the NASDAQ, you're actually under that. So if you close under that 50-day moving average, let's say get a continued slide in after hours, things look really, really bad from here. The next stop is about 416.45 on the NASDAQ, and this likely leads into a larger correction. Now, it's going to depend what Iran does, what Israel does, what kind of reaction these two countries have, the data coming out tomorrow. But right now, I can't say things look great, especially considering markets are selling off. The Fed was hawkish and TLT is, rising, right? That shouldn't be happening. That is a rush to safety. That is a fear move, and that is never going to be a good thing. Again, with that being said, I do think this leads you into a 7 to 10% pullback in the broader markets, as there are a lot of gains out there. Q2's not starting off on a good note, and there's a lot of profits out there. People, I think, are to the point. Maybe they want to take some off the table. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.